So financial crime and compliance management space is a very data-centric space. You are monitoring customer activity, transactional activity, account activity across different disciplines for AML fraud, know your customer, corporate security. And in that scenario, analytics becomes a very important tool which the banks employ for managing their financial crime and compliance management program. So analytics is basically a data mining and a data modeling, and it's a modeling and mining strategy which banks employ for financial crime and compliance management. Traditionally, if you look at FCCM or the Financial Crime and Compliance Management Program, you see that there's a lot of repeatability. The data which is being used for fraud monitoring, the data which is being used for anti-money laundering programs, for know your customer programs, there's a lot of data overlap. That means that banks have an opportunity to address these programs or address the requirements and needs of these programs without sourcing data from multiple sources. So data integration and having a single truth of data is an important factor if you want to do maintain your financial crime and compliance management program at a lower cost but at the same efficiency which the regulators demand. So I think financial crime and compliance management programs traditionally tend to be executed in a very siloed fashion. I think there are technologies, there are softwares and tools which can help bank consolidate this data, apply the right analytical tools and strategies so that we can get a single view of customer, a single view of transaction across these different programs and provide a better tool and a better program for effectively managing FCCM. The biggest advantage of strong analytics is to give you empirical evidence, to give you evidence in a qualitative as well as quantitative fashion in order to tune your system. The challenge which today financial crime and compliance management programs face, primarily from regulator standpoint, is that they want to catch the bad guys, but in the process of catching the bad guys, they generate a lot of false positives, they generate a lot of noise. And a strong analytics strategy can help banks reduce the cost of compliance by reducing that noise and focusing more time and effort on actual activity which is truly suspicious or fraudulent.